$2,700 by the end of the year. That's what Goldman says. Do you see gold getting to that level?
We are bullish gold, and the premise really is if you divide the two factors that drive gold, the short term and the longer term, they are poised to actually benefit from this trend. The short term is if the inflation tends to be stickier than we expected, gold is a good inflation hedge. If Treasury yields would go down because the Fed will cut rates, gold tend to perform well when Treasury yields goes down. The longer term, which is why we, as a firm, we have traded gold episodically, but this time around, it's going to be a permanent feature in our portfolio. And the reason is the dollar hegemony that has existed since post-World War II is coming to a test right now. And there's no alternative besides gold. So if you can see in terms of what you mentioned, central bankers as a whole has been buying gold for 9 consecutive months. China has been buying for 15 consecutive months. And in terms of in India and Turkey, they're actually almost holding the highest gold reserves ever. So we think the trend, both in the short-term drivers and the long-term drivers.
So you're convinced you should be holding gold in your portfolio. How much does gold account?
Very good question, actually. Gold itself is a negative carry. You know, if you buy physical gold, you're pay for storage. You buy a gold ETF, it's basically 40 basis points of expense ratio. Our analysis tells us that essentially you got to hold maybe around 3 to 5%, nothing more than that, because otherwise you take off opportunities to invest in other assets.
But that's no higher than normal, though, right? 3 to 5% is quite the norm.
As a firm as a whole, we have not hold gold for long periods of time. We probably have zero gold for a long period of time until last year.
Do you buy the dip?
Yes, in fact, we are trading the range. When it broke out of the 2,000 range back in fourth quarter last year was the first time we entered the market. We sold it recently. We're getting back in again. 2005 is probably where my target is. 2007 seems a bit rich, but you know the trend's there.
And in terms of silver, it's been playing catch up. In fact, it's done better than gold in comparison in terms of percentage. I mean, what are your views on silver?
I think at the end of the day, there is an application use here. There's no real application use for gold compared to silver in an industrial front. But for us, it's easier to buy gold. There's a very active gold ETF there. So our weapons of choice, sorry to use that word in this environment, has been to buy the gold ETF, yeah.
You know, we've been talking about the war over the weekend. Does that change the way you look at your investments? Does it change where you put your money?
For sure. I think when we look at what we were full risk on at the start of the year, the signing qua non for that was simply, you know, the economy stays in a Goldilocks environment. Disinflation continues, Fed cuts rates, and all this ambient noise that we're seeing, you know, all these ambient conflicts that we're seeing stays ambient. But obviously that, you know, uncomfortable truth that we have for 6 months right now has been broken. The impact obviously is not only just on oil itself, but the flow-through impact to inflation. And here are the numbers. Oil at $80 for a $10 increase translates to maybe 0.04 percentage point to core PCE. But however, if oil goes above 100, every $10 move above 100 translates to core PCE rising about 0.3 percentage points. So it's exponential when oil goes past the $100 threshold. And in the current market narrative where we're talking about sticky inflation, whether the Fed will cut or not, I think this is unwelcome news.
We were talking about $100 oil even before the attack over the weekend. Do you see $100 oil? And essentially as well, higher oil would be supportive of the USD.
I think going above 100 will require a couple of things to happen. First of which, Saudi or the OPEC Plus decides not to release some of their voluntary production cuts. And that's sizable because between Saudi and the UAE, they have about 3 million barrels of oil per day that in spare capacity they can release. Iran in itself produces about 3.6 million barrels per day. So just by simply UAE and Saudi releasing some of that, it will offset whatever Iran production loss could be. And we know Iran production will never be zero. They'll somehow be exported to markets that will want it.
Even if we don't get to $100 oil, it's still elevated above $90 a barrel.
Yeah.
Is that supportive of the US dollar?
I'm not too sure about that. I think the US dollar is more of a flight to safety, flight to safe haven assets. I don't see the connection between oil and the US dollar, but I think because of what the developments that has happened over the weekend, dollar should be on a bid as well. Yeah.
But weaker towards year end? Expectations, perhaps the Fed may make a move?
Yes, that's our expectation. We expect the dollar to weaken moderately. Yen is our preferred trade. We are of the view, quite contrary to the market at the start of the year, we are of the view that the Fed will probably cut 3 to 4 times, starting sometime in second quarter. The market had a very aggressive view at the start of the year, 5 to 6 cuts starting as early as March. We disagree with that. But we think that with the Fed easing and the Fed and ECB easing as well, they make it quite clear in June will be the timeline. That should offer some reprieve for emerging market currencies.